welcome to the Global View on India, Diwali Special with me, Tanvir Gill. My guest today on the show is Ravneet Gill, CEO of Deutsche Bank India. Ravneet, it's great to have you on the show. Thanks very much for taking out the time.
Great to be on the show.
Happy Diwali as well.
Very happy Diwali to you as well.
It's been a great year. I mean, this last somewhat for the markets, for the economy.
Absolutely, and I think there's plenty to play for. And the way we look at it, 2015 could be a year that redefines India in the eyes of investors, in the eyes of the Indians themselves. And I think we'll see a very different economic trajectory as far as the country is concerned. Okay. And also I think in terms of how we set our priorities, as a polity, as a society, and as an economy, we'll see a departure from the past. So very exciting times to look forward to.
Let me begin by asking you about the investment into equities. India's profile as an investment destination when it comes to the equity side of the business. S&P revising the outlook on India back to stable after 2.5 years. Do you think that comes as a reassurance that so far things are pretty much on the right track?
Yes, I think the way to look at it is as a reassurance. Moody's and Fitch were already there. And to that extent, I think this was just a reaffirmation of the fact that India is looking much better from a fundamental perspective. Is it a big event in terms of people's decision making? I don't think that that's the case. I think now for the first time we are seeing a situation where you could potentially look at a rating upgrade in 12 months' time. And I really think that it is for India now in terms of how it traverses its journey over the next 6 to 12 months, which will determine how equity investors...
So same time next year, if I was speaking to you, could we be looking at a ratings upgrade for India?
I think that's a very credible possibility. Also, I think one of the things that you need to notice is that if you see all the money that has come into equities this time, there have been lots of first-time investors, investors who have typically not put in money into the country. And I think if you're now beginning to see more of the long onlys, the sovereign wealth funds, the pension funds, which have historically stayed away, and to be fair, India hasn't really engaged them with any great intensity either. I think that's changing as well. And I think that what that signifies is that there's a change in perception as far as India is concerned.
What have their rough allocations been to India? Because if you go by the MSCI benchmark index, it's India allocation is at about 6.5–7%. So these sovereign wealth funds, these pension funds, how much have they started allocating to India?
Relative to their overall portfolios, a very small percentage. And I think at the moment what they're doing is that they're just dipping the toes in the water. And feeling their way around. And I think if there was a very sustained effort on the part of the government to reach out to them, build confidence, engage with them, take a decision or have a decision-making system which is much more inclusive, much more collaborative, you could actually see very significant funds coming in from agencies. So if you look at, let's say, an Norges or a CPP or for that matter an ADIA, relative to what their overall corpus is, a very small percentage really resides within India, and I think that could potentially change quite significantly.
What would be the tipping point of increasing those allocations? Because if you just look at the overall numbers, I mean, we've done about 13 billion in terms of FI inflows in equities this year so far, and you compare these numbers to numbers in 2012, 2011, they don't look that impressive. Given a year where there's been so much said about policy premium for the markets, the kind of expectations there are from the government, and just the enthusiasm. One would have expected the numbers to be higher this year.
So I think the traditional view, if you look at it from an economist perspective, is that it's capex that signifies economic recovery. And the fact is we haven't actually seen that much capex in the last couple of months, and people are then thinking that is a lot of that optimism really translating into action or not? The point is we have to look at India a little differently this time around. And the reason I say that is that for all the capex that happened in 2007, 2008, the expectation was that India would continue to grow at 9%, whereas India went down all the way to 4.4, 4.7%. So one, we already have a lot of capex on the ground and excess capacity. Second is that you had some very large projects that were commissioned where the capex was fully incurred, but for one reason or the other these projects didn't get off the ground. It could be because of last mile, environmental issues, coal linkages, rail linkages, etc. So the first thing that will happen is that this capex will get consumed where you have surplus capex or excess capacity, and these big projects will come on stream. All of this will lead to productivity of the economy, but not necessarily translate into fresh capex. So I would say that this time, if you are looking for recovery, the metric that you should be looking for is that is cash flow improving in the economy. And as a banker, I get the sense that over the last couple of months we've clearly seen a pickup in the cash flows, and that's also getting reflected in the fact that everybody's talking that bank credit hasn't been growing. And the reason is that on the one hand, cash flows have become stronger. You still are not investing in capex for the reasons that I mentioned, and given that we are currently in a high interest rate environment, corporates are looking to repay bank debts or liquidate their outstandings, and that's the reason why you're actually seeing no credit offtake. It is not because economic growth is slowing down, but this time the driver for the recovery is actually stronger, more robust cash flow, not so much capex.
So what are these serious money thinkers looking at in the market right now? If they're not deploying incremental cash, at what point do you think over the next 12 to 18 months would they in a meaningful manner increase their allocations to India? What is it that they want to see on the ground to make that decision?
So I think there are a combination of factors. So for the old India hands who have invested in India for a period of time, given what we've been through the last 3 to 4 years, I think there still is a certain level of skepticism. So they would like to see more policy action. They'd like to see more action on the ground. For newer investors, they'll get to know the government a little better. They'll get to know the new actors a little better, get more comfortable there. But like I mentioned, that what they will eventually want to see is capex on the ground, which I think is still 6 to 9 months away. And I think and when you start seeing that big projects coming on stream, fresh capex getting incurred, that's the time when you see that the allocations will suddenly grow. But will the improvement in India's GDP growth be predicated on just the capex? I would say that no, it will grow ahead of that based on the better cash flows and the fact that a lot of projects will come on stream that will lead to the productivity of the economy.
Yeah, the other aspect is earnings growth, which you're just outlining, and that's reflected in the markets as well, because right now the markets are trading at 17-18 times forward earnings. Deutsche Bank's December end target for this year is about 28,000. We're about 5-7% short of it. Do you also get a sense from these long-term investors that the market perhaps may have already priced in much of the optimism, and so they need to wait on the sidelines for a correction or a dip? Because 17-18 times, factoring in earnings growth of 17-18%, that's pretty much the higher end of the range that India has quoted at in the past.
So 2015-2016, we see earning growth at around 17%. Are now investors saying that okay, now we've
but these are projected earnings growth.
I agree.
Those numbers keep getting revised downwards as we've seen in the past.
No, of course. So the thing is that whenever there is a revival of sentiment, the first flood of investment comes on the back of sentiment, and then investors take a pause and then wait for earnings, then to be able to go in with the second investment thrust, if you will.
Sure.
And I think India is going to be no different in that sense. Has the sentiment been overdone? I don't think the sentiment has been overdone. I think the investment that we have seen in equities, in debt, is very much in keeping with the expectation that India will now find second wind and again surprise the world on the upside in terms of its growth. So the way we look at it is that India will now see a secular bull run, if I may use that expression, over the next 5 to 7 years. And I just think, like I mentioned to you, that once the sentiment changes, discretionary spend comes in to play. A lot of the slowdown that you saw in consumer durables, in the FMCG space, that is beginning to reverse itself. We know
actually, interestingly, it's showing up in the consumer space.
Yes.
You're looking at FMCG companies delivering on earnings. Auto companies have come out with a good set of numbers. Yes. So the consumption side of the market is actually showing the signs
yes.
of an improvement, but it's not really translating on the investment side.
So like I said, that currently you still have a lot of surplus capex on the ground. And you need the sentiment and this new growth to express itself and consume that capacity before you will see fresh investment. Also, don't forget that when you're talking about fresh investment, people have a certain expectation also that currently we have a high interest rate environment, and they may want to wait a little bit before they start investing. I also won't want us to forget one other factor which could be driving the entire investment sentiment is that if, for instance, the US Fed does increase rates middle of next year, as is generally believed, you could see a big reversal of flows from the emerging markets. And if that happens, then obviously the rupee will come under pressure. Now, you don't want to be in a situation where you embark on capex and then suddenly start seeing that the rupee begins to depreciate and the project cost goes totally awry.
Okay, let's talk about the broader debt market then. This year, interestingly, we've got about $18 billion into the debt markets, more than what we've seen in the equity markets. Would you say that this is primarily on account of the reversal, on account of outflows that happened last year? Or has it been a combination of an attractive yield plus the default risk going lower for India?
The latter.
Okay.
So I don't think that this is just a backfill for the money that found its way out last year and which had such a huge impact on the rupee. I think today, first, investors believe that India's fundamentals, and again you can talk about the two twin deficits, you can talk about reviving GDP growth. They feel much more comfortable with that. And again, I think don't forget that for the first time in 30 years we have a majority government at the center. So people feel that they will be able to pull through their mandate with a lot more conviction than previous governments have been able to do. Second is that corporate India is recovering. There's no question about that. And again, I think even in the last couple of years, it wasn't as if anybody questioned the fundamentals of India's economic growth. The question was in the short term, what would be the challenges that corporate India would be facing, and how would it cope with it. So there's a general belief that the bottom has been hit, and from here we're beginning to see a rebound. And as typically happens when you see markets rebounding, investor interest follows.
Isn't a part of the interest a function of the yield being attractive with the expectation of a possible rate cuts, which haven't come by, but you've seen the yield adjust?
Yeah, so if you look at the yield on Indian paper is very, very attractive at this point in time. The question is that if you look at some of our neighbors and or other emerging market economies, India actually is providing a high yield.
Yeah.
Is that warranted? It's always open to debate. The question really is when we talk about a potential rate cut, it's always discussed and analyzed in context to the inflation. That the inflation targeting is being done through interest rates. Let's come back to the point that I made with respect to what the US Fed will do in May, potentially in May next year. If there is a reversal of flows from EM, I think India is very conscious. The Reserve Bank of India is very conscious that India doesn't get hit too hard, and to that extent they need to keep interest rates high. Yeah. And so it's a mix of inflation targeting and also keeping that buffer for any contingency. But if you look at it from an investor's perspective, what they see is a high yield. Improving economy, very decisive government in the center, and high yield. So makes it very attractive to put more money in.
Okay. What about currency volatility at this point? How are you looking at the currency move? Again, in relation to the point that you highlighted on rates going up in the US and the dollar becoming a more attractive currency, the rate differential between the US and India, what happens to the rupee?
So I think if you see ever since the Jackson Hole, emerging market currencies have taken a battering. Equity markets have taken a battering as well. But if you see India has actually performed better on both those fronts, both equity markets and currencies. Now, our thesis that investors are looking at India in a slightly differentiated manner relative to other emerging markets. I think if you look at it only a time frame of 30 days, I think it's too short. But we think that our thesis is correct and it will play itself out. I also think that this time around India, both from a reserves perspective and from a preparedness perspective, is in a better position than it was last year when the tapering happened. And to that extent, I think the Indian rupee will be a little more stable.
Okay.
But
stable would be around 60?
I would say between 60 62.
Okay.
But could the rupee come under pressure on a short-term basis and lead to some volatility if the interest rates did rise in the US? We should not discount that possibility altogether.
Because that's having an impact on the forex reserves. I'll come to that in a bit. But the much talked about, much controversial issue right now and much debated has been getting India listed on the International Bond Index. Now, you've been an advocate of that. And there are arguments in favor and against it as well. What is the view that you're taking right now?
So again, when we talk to the regulator and we talk to Ministry of Finance, the sense we get is that listing on the international bond indices may not be a short-term proposition. they feel concerned about the fact that if you want to be listed on the international bond indices, you need to do away with all the quotas. Are they completely comfortable and secure that we can do away with those? I don't think that's there yet. But the other thing that we've also talked about is getting listed on Euroclear, and I believe that there is good progress being made on that, and I think that is likely to happen sooner than later.
Yeah, but do you think that that would be a good solution right now, if you're looking at long-term sticky capital coming in via the debt route, in just helping the government manage the current account deficit?
So there are very large funds out there which don't invest, unless you're listed on the international bond indices, and to that extent, we've fenced ourselves off from that capital. That said, we still have.
What kind of money are we exposing ourselves to if we do get listed on an index like this?
So I'm told that you are talking about funds which go up anything from 500 billion to $1 trillion, which don't even look at India because India is not listed on the international bond indices. But the point that I would make is that there's still enough out there to garner for India without having to take that step. So I think if we do get listed on Euroclear, I think that potentially could be seen as a very, very positive move. And like I said, that there's been a category for financial investors, which is the sovereign wealth funds, insurance companies, pension funds, etc., which we haven't really engaged with any real intent in the past. And I think it's very critical that we are able to do that. Also, I think if you look at it in the present government, one of the things that they will do is that bilaterally with a lot of the governments, especially in the East, they will establish large lines of credit. And this is money which was not coming in the past, which may now start coming. So if Japan is talking about going up to about $35 billion, relative to $2.5 billion that they typically do every year, that will be a big jump. And I think China, Korea will also become partners in that sense.
Okay, but do you think that there's a compelling need right now to make that decision to get listed on international bond index over the next, let's say, 6 to 8 months, or even perhaps from a 12-month time horizon, or there could be a stronger case to focus on building FDI into the country and make that as the mainstay for managing the CAD?
So as far as the first point is concerned, in terms of listing on the bond indices, I will always say that the regulator is better positioned and better equipped to take that call. And I think they will take a very holistic view, as and when they do make that call. But like I said, that there doesn't have to be. We don't need to be in a tearing hurry to get there. I still feel the latter point that you made in terms of being able to get into the FDI route, and then catch and really build stronger linkages with the long only funds. That could solve for India's needs for the time being.
Let's talk about your outlook over the next 12 months in terms of the macro variables. The last reported growth numbers were encouraging. Does that sustain? And what are the numbers that you're looking at?
So, will that sustain? I think those can sustain. So the typical consensus view on the street is that India this year will grow between 5.6 and 5.7%. I won't be surprised if India actually hits 6% this year.
Oh, okay.
And the reason I say that is, again, simply because typically when economic recovery starts, there's a lag period based on putting capex and that capex coming on stream. Sure. India already has a lot of installed capex. The question now is, higher capacity utilization, which you're beginning to see. So you mentioned in terms of the consumer durables, you talked about the FMCG, you were talking about the car companies. All of that is happening. Also, like I said, that
But that would also mean that over the next 3 quarters, we're going to be seeing a growth of 5.5% plus, if we were to even come close to that projection.
No, I think no, absolutely. So the next 2 quarters have to be really heavy-hitting quarters for India. Could those be heavy-hitting quarters? The fact that I'm saying that I won't be surprised if India actually hits 6% means that I have a certain conviction that these 2 quarters will be heavy-hitting quarters.
Despite manufacturing being at a 9-month low, the last reported number.
Yeah, I think it's very difficult to take tactical calls when you're talking about something like GDP growth. GDP growth is many elements go into that, and you can't really calibrate and recalibrate that on a quarter-to-quarter basis.
That's on the growth side. What about deficit and the aggressive target that's been laid? From in the April to August quarter, we've done about 75% of that aim, which is a bit of a worry. We've still not seen inflation come come off in a manner which would be comforting for the RBI, and earnings growth is yet to pick up. I'm not trying to be skeptical out here, but are we really jumping the gun and being over optimistic? Is recovery still a reality 6 months down the line?
So, as I said, the recovery, to my mind, is not 6 months down the line. The recovery has started, and like I said, that unlike in a typical economic revival where you see capex, this time I'm seeing stronger, more robust cash flows. So that's signifying recovery for me. Can the target of 4.1% be hit in terms of the fiscal deficit? I think even if you see from in the case of the previous government, when they put a fiscal deficit target, there was a lot of skepticism around that. Question is that those targets were met. And I, based on everything that we've seen, based on all our discussions with Ministry of Finance, is the government on course to being able to meet that target? The answer is yes. The question which I would focus on, or the aspect of your question that I'd really focus on, is the revenue part. That are we seeing quicker momentum as far as velocity, as far as revenue growth is concerned? That is what I would focus on. I think everything else will, do
you think tax revenues will pick up in the second half of this year?
If earnings improve, tax revenues will pick up. And I think the point that has always been made that, currently, if you talk about inflation, you talk about sustainable growth, supply side issues need to get addressed. And I feel very heartened by the fact that the focus of this government to, address those supply side issues is very, very good.
So what worries you about India at this point? I mean, we've been talking so much about what is working for India. What may not work for India? What's the risk?
I think 2 or 3 factors. So let's talk about the more fundamental factors to begin with. I think currently a couple of global cues have a much bigger bearing on how India would look in 12 months' time, or let's say 6 to 9 months' time, relative to any internal factors. So some of those are geopolitical factors. We talked about the fact that what potentially could happen if the US Fed was to increase rates. If we talk about the internal challenges, I think based on how this general election was fought, I think expectations are very high. I think those high expectations are warranted. I think maybe what is not warranted is the impatience. You're talking about a very big country turning around, and typically a warship doesn't turn on a dime. So you need to give a little bit more time. I think people would have felt a little more comforted if they had seen some capex getting incurred or large projects getting announced. Like I said, that that's not what we need currently. We need that the capex that's on the ground, that capacity gets consumed. Projects which have already been fully commissioned should come on stream, and they will give a very good fill up to the to GDP growth. But I think we need to give this a little more time in terms of being able to pick up the right signals, straws in the wind, if you will, that things are actually turning around. And like you said rightly, that whether it's investors, whether it's you and me, can we see a perceptible change in sentiment? I think yes. And so let's try and build on that momentum rather than look for what's lurking at the next corner.
So same time next year, do you think because we've been hearing about India getting re-rated for the last 6 months?
Yes.
Right? Maybe part of the rally is reflecting that, but do you think in a material manner we would get re-rated, maybe with a ratings upgrade, which is going to be a big one for India?
Yes.
Same time next year, you think that that's possible?
My sense is that some of the rating agencies could move from a stable to a positive on India in the next 6 months.
Yeah. But the investment grade?
And then so we are investment grade at BBB minus currently. Could we get to a BBB in 12 months time? I would say well within reach. So my sense is, as I see the roadmap, that over the next 6 months, agencies which are currently stable may turn to positive, and then another 6 to 8 months from there, you could potentially see the first rating upgrade.
So same time next year, if I speak to you, it's going to be another very happy, joyous year.
Enlightened self-interest tells me that I hope it plays itself out like that, because the impact it will have on the economy, the impact it will have on the fortunes of all of us will be hugely beneficial.
Oh yeah, and we're hoping for that.
Absolutely.
Thanks very much, Ravneet, for joining
Thank you,
me.
Tanvir. Thank you. Always a pleasure.
Well, that's Ravneet Gill, CEO Deutsche Bank India, saying that 6% growth in FY15 is possible for India, and that India is well on its way to seeing a ratings upgrade 12 months down the line. On that optimistic note, thanks very much for watching The Global View, Diwali Special with me, Tanvir Gill. From the entire team at ET Now, we wish all our viewers a very happy and prosperous Diwali.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.